If you've ever found out that your credit sucks because you maxed out your Star card, go ahead and hit like and subscribe. My name is Daniel Lehman, and I'm answering all your VA home loan questions. All right, today's question is about the VA funding fee. What is it? How does it work? What is it for? And I am going to pull up the funding fee chart and run through it with you, and also show you a couple ways that you could mitigate your costs and how to structure your file to limit the cost and even exclude the funding fee altogether. So if you got questions about the funding fee, I'm going to answer it. All right, so this is the funding fee chart for 2020 and 2021 and from 2020 on. All right, what is the funding fee? The funding fee is basically the way that the VA is compensated for the guarantees that they do. In essence, it's a VA charge. It goes to the Department of Veteran Affairs, and it's the only fee directly that VA charges. And because again, to reiterate from other videos, the VA doesn't do loans. They just do the guarantee on the loans. So how does VA funding fee work? In essence, here's your chart: 0 down payment, 5% or more, 10% or more down payment. Percentage for first time use, percentage for subsequent use. First time use is obvious. It's if you've never used your VA before, but you're eligible, your first time use will go in this column. Any subsequent use will go in this column. That means your second, third, and anything else. You can use your VA more than once. You can use your VA at the same time as you have a VA loan out, as long as you have remaining eligibility. So how does a VA loan work? And I'm going to use the really straightforward, because I'm not that smart, loan amount or purchase price of $100,000. So let's say you buy a house for $100,000. The funding fee does not have to be paid in cash. In most cases, it's rolled into the loan. So if it's your first time use, your funding fee, 2.3% of $100,000 would be $2,300. So you don't have to come to the table with $2,300. What ends up happening is your purchase price is $100,000. You put no down payment. Your funding fee is $2,300. It gets added to the loan amount. So your loan amount ends up being $102,300. Subsequent use gets a little funky. So if it's your second, third, or anything after the first time use, what's going to happen is you're going to pay a 3.6 if you put 0 down. So a lot of times what we do in those cases is we structure files. And a lot of times this is like someone selling their first home and buying the next. So maybe they're taking some equity and rolling it into the next purchase. And that makes a lot of sense to do. But it would never make sense to put like 4.5% down on a VA loan. You want to work within these increments. 3.6 down to 1.65 is a really big difference, especially if you're buying your second home and you're moving up, and maybe you're buying a $5 or $6 or $7 or $800,000 property. 3.6% ends up being quite a bit. When we bought our house in Carlsbad, we would have been paying a 3.6% funding fee on a $960,000 or $980,000 purchase. $960,000. That would have been chunky, but that brings me to my next point. Service-connected disability rating waives the funding fee. So all of these numbers turn into 0 if you have, the easy way to explain this is if you have 10% or more service-connected disability, your funding fee is waived. The real way to answer it is if you're getting a check from the VA due to disability. There are some other things like Purple Heart. There are some other caveats to this. So you want to pull your certificate of eligibility, and your certificate of eligibility will show whether or not you are due a funding fee. But the most common and the most typical way that the funding fee is waived is 10% or more service-connected disability that is compensatory. I don't know which word is correct. But if you're getting a check, that will waive your funding fee forever. So use this chart to kind of apply how much funding fee would apply if you're active duty or if you don't have service-connected disability. If you're getting out sometime soon, make sure you do your trip to medical to get your stuff on file so that if there is a claim for disability, you get your benefit. And the last thing is, let's say you buy a house or you want to buy a house. You've applied for your service-connected disability, but we know how fast the VA is. It's lightning fast. No, they're not. So they take a while. So let's say you apply for your service-connected disability. You buy a house and pay a funding fee, and then after you close, you get awarded your disability. If you're awarded the disability and you've applied before you bought and paid a funding fee, you can get your funding fee refunded to you. So that money will come back to you. They'll generally, I think right now what they're doing is they're cutting you a check to pay you back the funding fee. So you can, it is retroactive. So if you apply, if you get it on file that you are requesting service-connected disability, and then you close, and then you are awarded service-connected disability, your funding fee will be refunded. All right, so the funding fee is one of those things that's pretty VA specific, and hopefully that run through of kind of what the VA funding fee is and how to mitigate some of the costs and how to get rid of it. And again, if you're getting out sometime soon, make sure that you get your VA disability stuff on file because it can help a lot if it's warranted. If you have any questions about it, leave it in the comments below. Remember to like, subscribe, all the good stuff. And I will talk to you later.